Ladies and gentlemen, good day and welcome to IPCA Laboratories Q3 FY’25 earnings conference call hosted by DAM Capital Advisors Ltd. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nitin Agarwal from DAM Capital Advisors. Thank you and over to you, sir.
Thank you, Ms. Khan. Good afternoon, everyone, and a very warm welcome to IPCA Labs Q3 F’25 post-results earnings call hosted by DAM Capital Advisors Ltd. On the call today, we have representing IPCA Lab management, Mr. A.K. Jain, Managing Director, and Mr. Harish Kamath, Corporate Counsel and Company Secretary. I will hand over the call to Mr. Jain to make the opening comments and then we'll open the floor for questions. Please go ahead, sir.
Thanks, Nitin and DAM Capital for organizing this call. Today's call and discussions and answer given may include some forward-looking statement based on our current business expectations. This must be viewed in conjunction with risk that pharmaceutical business face. Our actual future financial performance may differ from what is projected and perceived. You may use your own judgment on information given during the call. The domestic formulation business has delivered around a growth of around 13% for the quarter. On December 24, IPCA is ranked as the 16th company as per IQVIA and is fastest growing among the top 20 players. IPCA continued to improve its market share. There is 11 basis point improvement in market share in this particular quarter from 1.95 met market share at December 23 to 2.05% on met December current financial year. 6 brands of the companies are among the top 300 brands in the country, and both on acute and chronic market segment, we are delivering better growth compared to the market. Overall pharma market in this quarter has grown by around 7.4%. IQVIA is tracking our growth at 11.4%. On acute segment, market has grown by around 6%. Our growth is tracked by IQVIA as 8.7%. And on chronic segment, IPM growth is around 9.7%. And in this period, we have grown by around 17.1%. Overall, our formulation business has delivered a growth of around 6% for the quarter. And API business has also delivered a growth of around 12% for the quarter. If you look at our standalone Q3 FY’25 EBITDA margin, it is at around 24.25% as against 18.52% in Q3 FY’24. There is an improvement of almost around 5.73%. If you look at 9 months basis, we have delivered an EBITDA of around 23.14% as against previous year 9 months of around 19.55%. There is an improvement of almost around 3.59%. And overall guidance for the year was around 21%. But for whole of our financial year, our EBITDA is likely to remain in the range of around 23 to 24%. Overall, on consolidated EBITDA margin basis for Q3 FY’24 is at around 19.87% as against 16.1% in Q3 FY’24. There is an improvement of around 3.77%. And if you look at 9 months basis, it's around 19.18% as against 17.34% in the previous financial year. There is an improvement of almost around 1.84%. As against overall our guidelines was around 18% for the year. As against we are delivering around 19.18% and hopefully 19.18 to 19.5%. This is the range in which the overall consolidated margins would remain for the current financial year. So both on standalone and consolidated EBITDA margins are better than our guidelines for FY’25. Having given the broad numbers, now I'll request participants to ask questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and one on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Surya Narayan Patra from PhillipCapital India Private Limited. Please go ahead.
Hello. Yeah, congratulations for the good set of numbers, sir. My first question is, hello, can you hear me?
Yeah, you can hear. Yes.
Okay. First question is on the gross margin, sir. So I think the positive surprise in the quarter, what we are witnessing is in the gross margin. And if I see this is one of the highest ever gross margin number that we have seen for the quarter. What is driving this and how sustainable is this one, sir?
The gross margin this particular quarter was exceptionally high, mainly because overall, let's say, the turnover in this quarter has grown by around 10%, but material cost, there is a significant reduction. Against 10% growth, material cost has come down by around 5%. So that is the impact, and that's the impact is mainly we don't see any kind of reduction in the material pricing. More or less, pricings are more or less here and there. There is hardly any change. So it's a certain kind of product mix improvement that is there that has helped us with a better gross margin. And another factor which has happened that last year in the same quarter, our ROW market business was very low. It was around 104 crore or so. And this year it has grown by almost around 50%. It's only because some shipments here and there has happened in last quarter, and that has resulted in the lower. But in this particular quarter, that number has come high. So that has also added to the overall to the margin because there our margins are better and it's the highest as a company as a whole in any business line. So that has also helped in the overall better margins in the current quarter. But there is a significant improvement is there. If you look at each quarter by quarter, our material cost ratios are continuously improving. If you look at number on standalone basis, in quarter one material cost ratio was around 28.9%. In quarter two it was around 29.59. This quarter it has come to around 27.62. And overall for the 9 months it is at 28.73%. So more or less for the fourth quarter also it will remain around 28.73 or that's the kind of broadly around that 28 to 29% is what is the overall. So and last year for the first 9 months this ratio was around 32%. So if you look at 9 months versus this, so there is almost around improvement of 3.37%. So that improvement is there in overall in the current financial year. So it's largely because of better product mix. And our overall, if you see that our chronic portfolio has done well, we are delivering much better growth now, and we are beating the market on the continuously on chronic also. So that is also helping overall in the margin improvement.
Okay. And is it fair to believe, sir, even the turnaround of Unichem, that is also kind of playing role in the gross margin improvement here in the consolidated level?
I was talking of standalone side. As far as Unichem is concerned, last year around same time they were having around 5% EBITDA margin. And now their EBITDA margin has also improved to almost around close to 12%. So that is also helping in consolidation to deliver the better margins.
Okay. So the second question is on the US business front, sir. So could you give some color about the kind of the progress on the product launches from our portfolio, although now it is been included in the Unichem's portfolio, and now considering the integration of this US business in Unichem, so how should one monitor the progress of our US business in Unichem? Because, or in the light of that, are you going to give a upgraded guidance for Unichem, sir?
As far as IPCA portfolio in Unichem is concerned, I would say that we have shipped around 4 products till now, and almost around 7 to 8 products are in pipeline. So, and mostly the stocks has gone in the current quarter and end of last quarter. So nothing meaningful has happened as far as the overall consolidated numbers are concerned. We have made shipment from here, but it will take some time for the market bidding and all that. So that process has just started. We have started winning some kind of the bids and all. So in the coming quarters, that will start reflecting. But right now, US business doesn't have much of impact as far as our overall business is concerned currently, because hardly any meaningful number has come so far. Yeah.
Okay. Just last one question from my side about the institutional business. In the light of all these funding issues by the agencies, so how should one think about the injectable business that we are having, which was a kind of a promising business, and a futuristic business opportunity, what we're targeting through hormonals? So how should one think those potential business and the existing business in the institutional side?
As far as institutions are concerned, it's by and large anti-malarial business only. And I think in current scenario where US has abruptly stopped the US aids to the various program, so we are still assessing the impact of that. So currently we have not heard from any institution any kind of cancellation of orders. But we have calculated our internal number that what kind of business on a year basis we were doing with where the aids were given by the US aid to the concerned donor. So that business is around 40 crore. Yeah. So how much of that will impact? Right now it's difficult to say.
Okay.
But yes, that is the number which we have, which is relating to US aids business. And we really don't know how much US aid is giving funds to the global fund. So if global fund is also receiving the US aid, then how global fund will thereafter take up, that number is not known to us. So I will not like to comment on that.
Sure, sir. Yeah.
There could be some US aid to the global fund. So that is not known to me right now.
Sure, sir. Yeah. Thank you.
Yeah.
Thank you. The next question is from the line of Shiva from Protnana Investments Advisors. Please go ahead.
Hello, am I audible?
Yes.
Yeah, you are audible. Yeah.
Okay, thank you. Firstly, congratulations on a great set of numbers.
Thank you.
Especially with respect to the margins. My first question is with respect to generics. This quarter, there was a slight bit of weakness. Could you just say any particular reason, or what was the reason behind that kind of slightly low numbers in generics?
By and large, this lower generic numbers are mainly because of South Africa. We were doing a business of around 120 crore in South Africa in a year. I think this year the number may be around 40 crore or so. So there will be almost around 80 crore kind of 75 to 80 crore kind of decline in South Africa business because of some tender orders are lost and all those kind of things are there. But we are working on next year's plan, and there will be significant improvements are likely to be there in South Africa business in the next financial year. But in current financial year, that's the one reason which has overall impacted our overall generic numbers. Yeah.
Okay. And with respect to Unichem, obviously there was a steady progress and the margins have done way better than expectation. So just wanted to understand for the next 1 year, how are you looking at, because the margins have improved better than what we have expected during the acquisitions time. So how are you looking at Unichem's growth and margin for the next 1 year? Or what are the kind of the levers that have you played and what are left? If you could give more color to that.
So right now, it's all the improvements which is coming is basically it's improvement in operations all. It's the synergetic benefits and your extending the product range to the other markets and other developed market and all. That's a little long-term gain. So right now it is basically all improvements what we could brought about in the overall in Unichem's operations and buying efficiencies we have created. That is what is reflecting in their overall margin. And we are also asking our US team to be a little more aggressive and all. And we have monitoring that part. And we see a much better business which is coming now in US also. And overall, it's basically improvement in operation that has got the results right now, and a long way to go, I would say that. The margins will keep on improving as far as Unichem is concerned.
Oh, that's good to hear.
A lot of work which is happening on API side is in work in progress, because API efficiencies are one where it will also reduce the captive consumption cost, and also right now Unichem is not able to sell the APIs to the let's say the Indian market or other market where the price is more of a price sensitive markets and all that, is because their overall production cost is higher. So they are mostly consuming the API for their own production for US and all. So once we start improving efficiencies on that and all, so that will also bring a lot of continuous improvement. And these improvement numbers will start reflecting in the next 1 or 2 quarters, because one of their the bigger plant which is likely to be operational maybe in the next quarter somewhere. So that will start reflecting after a quarter or so, once the regulatory approvals and all start coming in, filing happens from there, and some kind of once they start captive consumptions of those materials, so cost of API production will go down. So there will be continuous improvements will happen in Unichem's operation for that.
The participant left the queue. We'll move to the next. The next question is from the line of Tushar from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity. Sir, just extending your comment now with backward integration of Unichem's formulations and subsequently, chronic share increasing in India formulation business. Qualitatively, at least, if you could share, compared to FY'25 Concall EBITDA margin, what kind of margin one can think for FY'26?
So right now the budget exercise is going on. So once the budget numbers are finalized and overall we work, so normally we give those kind of guidelines along with our the first quarter, last quarter results. So around that time we will give the guidelines. But I would say that the margins are improving and will continue to improve. But the guidelines we will be able to give along with our annual results.
Got it. So secondly, just on API products portfolio level, is the inventory now more or less getting normalized at industry level, or we are still seeing pricing pressure?
Right now, we have not noticed any kind of pricing pressure. Somewhere some solvent prices have moved, other solvent prices have come down. I think on the chemical side, there are hardly any kind of movement, and intermediate side, we have seen slight improvement in few, but we have seen a reduction in many more. So overall basis, I would say this is a neutral, and I don't foresee that in next 2 quarters also there could be any kind of further improvements in the overall let's say increase in the prices. So more or less the similar trend will continue.
Got it. And just lastly, the effective tax rate, how much to think about for full year 25?
Overall tax rate for us is 25%, but some kind of disallowances on CSR and also on the marketing costs and all right. I think overall tax will remain around 27 to 28% kind of thing.
All right. Thank you. That's it.
Thank you. A reminder to all participants, you may press star and 1 to ask question. The next question is from the line of Ms. Nitin Agarwal from DAM Capital Advisors. Please go ahead.
So thanks for taking my question. Sir, on the generic business, so can you provide an update on the EU and the UK market? How have they sort of done so far in 9 months, and how are you looking at it going forward?
Overall, UK was also very fiercely competitive market. So overall, I think UK numbers are muted, more or less in the line with what we had previous year 9 months. So it has not grown. EU numbers we had good growth in EU. So around 14-15% is the overall growth there. But overall, South Africa is a little down, and also Australia, New Zealand numbers are down. Australia numbers are down mainly because of some supply chain issues on API, which we were using for formulations. But now that issues are resolved, so in this quarter, Australia numbers has improved, and I think overall in next quarter also those numbers will improve. So that's the broad reason for overall lower growth on generic side.
And so looking forward, is the UK business, how will it look? Because we were expecting a turnaround in the business. That I think is coming slower than expected. So how are we looking at the business now? So when we look at or take a 2-year view on this business?
Let's say, I think second quarter there was very bad, but third quarter onwards, the prices have again started improving there, and businesses started improving overall. And I think we had a lot of launches also in pipeline. So I think in UK numbers, we will see around 15 to 17% kind of overall growth in next financial year.
And so Europe will continue to grow at these double-digit growth rates?
Yeah.
And then lastly, on branded formulations, what drove this such high growth this quarter?
It's only, let's say, last year on the same quarter, the number was very low because the shipment in that quarter was low. And now it has come to the normalized level. So this quarter number is broad, more or less is similar to plus minus 5-7% compared to the other quarter. So more or less that impact is of one-time impact because the number of last quarter, Q3 numbers last year was low, so it's appearing to be a high growth. But overall on these promotional market business, we are looking for around 8 to 9% growth for the whole of the financial year.
Okay, sir. And then lastly,
and growth number is little muted is also because of your ruble, depreciation of ruble.
Right, sir. Right. And then lastly, on the API business, sir, how should we now think about the API business going forward?
8 to 10% growth.
Okay. And sir, the newer capacities in both Devas and all of Devas have come through now? You start using the Devas capacities?
Yeah, Devas capacity we have started already. Yeah. But capacity utilization is around 35-40%. So it is still because a lot of regulatory approvals have yet to come and inspections are pending. So once that happens, then capacity utilizations will pick up.
Okay. Thank you, sir.
Thank you. A reminder to all participants, you may press star and 1 to ask question. The next question is from the line of Surya Narayan Patra from PhillipCapital India Private Limited. Please go ahead.
Yes, sir. So this is an extended question about the APIs. In fact, sir, API export particularly, that was one of the key earning driver also for us for a longer period of time because of our cost effectiveness there. But if I see that, okay, during the COVID period, the kind of run rate what we have been seeing, even after 4-5 years, we have not touched that number. So obviously there was the issue post the this impurities in the couple of key APIs, what we've seen from the UK side, post that we have seen there is a kind of a moderated performance only. So if you can give some sense of what is currently, or which are the key products which are currently the drivers, and going ahead, what should drive the growth for us, whether it is a new product or it is a new capacity that will drive the API. Could you give some sense about the API portfolio as a whole and the export market particularly?
Let's say on COVID period, the major the API business built up was around chloroquine and hydroxychloroquine because they were required for COVID, and that has also came with good pricings and all. So that has given overall high numbers around that time. And subsequently, we have faced the problems on certain business. That has resulted in overall lower growth, and also we were carrying higher inventories and which were at higher intermediate pricings and all. And pricing has slashed down to around from $100 level to almost around $40-50 level now. So around now. So that has also resulted in overall turnover number coming lower on that account, and prices of intermediates also of those API has significantly declined. So that has resulted in overall lower numbers. And overall portfolio-wise, we are also adding the APIs, and also on portfolio approach. Now all these things are things of past. We also lost a significant business in Iran. We were doing almost around 75-80 crore kind of business in Iran, and today that business is zero. So that has also resulted in overall lower because they don't have the dollar or currencies to pay, and therefore that market we are not able to sell anything right now. So that business has also come down. So that consistent business what we have on Iran is no longer there with us. So that has also impacted overall business. And now since portfolio is also increasing and we have Ratlam capacity, by and large the incremental capacities will be used for the US captive consumptions and all. Devas capacity is available, and all that will result in around 8 to 10% kind of overall API business increase. More specific numbers I will be able to give after along with the fourth quarter number, where after our annual budget exercise is complete, and we will be able to give the proper guidelines on that.
Is the statins still a kind of the largest product segment for our API business?
Yes, individual number-wise, yes, this is giving highest growth, highest overall number. But and we are also seeing that with even volume number going up, overall your sales number is not moving up. Some market prices have started moving up, but overall on mixed basis, I would say that number is still muted. Yeah.
Okay. Just on the US business side, from the perspective of Unichem, now since they are having the integrated operation at their end, so we know that pre-acquisition it was a loss-making business because of the water was kind of not so significant integrated portfolio, as well as not so complex generic products there in the portfolio. So here onwards, that Unichem as a whole, it's a kind of significant chunk of the consolidated business. So going ahead, what is the strategy there for the US business on a consolidated basis, and how should one think about that, particularly regards US? Also considering the concern of the tariff and all that, so how should one really position about Unichem's larger portion of the business, which is US?
So if you look at Unichem business, the product portfolio is of the older products only, and they are continuously launching 3 to 4 kind of new products every year. And probably in the next few years, at least 5 to 6 kind of launches can happen year on Unichem's portfolio. and on IPCA portfolio also launches would happen. With consolidations with Unichem, the business overall, so what kind of expenditures, duplicate expenditure was there, that we have already eliminated. And that benefit has started coming because standalone Bayshore was having this again marketing operations and cost, and they were not able to recover those costs because business operation around that time and when we were not having FDA approval. So that cost was a burden. So that cost has gone out now because Unichem already has those kind of people and they don't need to hire additional people to do the Bayshore and also IPCA business. So that is resulting in overall in the operational cost decrease for us.
Okay. And this last one, please, sir, about the subsidiaries, how do you see their performance?
I request you to rejoin the queue, please.
Sure.
Yeah. Thank you. The next question is from the line of Gagan Tareja from Axe Investment Managers. Please go ahead.
Yeah. Good afternoon, sir. So the first question is on the gross debt levels. If you could give out the gross debt levels and how should we think of it going ahead?
Overall, I think gross debt is around 900 crore in the balance sheet for IPCA standalone. And we have almost around 600 crore of cash. So net of cash, we have around 300 crore kind of debt overall. Cash what is available with us. And I think next financial year, practically that number will become nil because this repayment and all, overall if cash holding and if you see, net debt would be practically zero.
This is on the standalone level, on the consolidated level?
Standalone level, yeah.
On the consolidated level, what would be the gross debt?
Consolidated level, there are hardly any borrowings in Unichem. So it's not maybe less than about $12-13 million. $30 million overall.
All right. And on, can you also give the salience of $0 and its line extensions in your domestic portfolio, and how has that franchise grown for you year to date, and what do you think of that particular brand going forward?
Overall, if you look at the pain portfolio, overall for the first 9 months of current year, on pain portfolio we have grown by around 14%, which include osteoarthritis and rheumatoid arthritis both. So in both the market segments we have leadership, and that portfolio has grown by around 14%. Yeah. So that portfolio continued to do very well for us. But certain markets like anti-malarial this year has not grown, so practically zero growth on them. Antibacterials has just grown by 1%. Cough and cold has grown by 4%. So these are the portfolios where we have lagging. Our cardiovascular portfolios are now doing better. Our urology, then dermatology and nutraceuticals and also gastrointestinal portfolios, they are doing better. So overall we have around, if you look at first 9 months of current year, on overall portfolio we have around 12% internal growth. Yeah.
Okay. And on the subsidiaries, if you could give some flavor of, the subsidiary performance both at a P&L level and also at a balance sheet level, if some details can be given out.
Except PISGA and our associate company Krebs, other all companies are profitable as on date. Bayshore, as Mr. Jain has said, we were incurring losses because of administrative cost. That has gone from our books now. So only PISGA and Krebs are little cause of concern. Other than that, all subsidiary and associates, there are profit in the consolidated level.
Okay. All right. But potentially there would be room for further improvement in margins in all of those?
Yes, definitely. Everywhere there is potential room to improve margin.
Right.
Especially PISGA, we are working on long-term plan and all. It should turn around in a couple of quarters.
Okay. Thank you, sir. I'll get back in the queue. Thanks for taking my questions.
Thank you. Yeah.
Thank you. A reminder to all participants, you may press star and 1 to ask question. The next question is from the line of Pulkit Singhal from Delmus Capital Management. Please go ahead.
Thank you for the opportunity and congrats on a good set of numbers. My first question is on the U.S. portfolio for IPCA that's going to be marketed by Unichem. What is the potential, revenue opportunity for you over the next 3 to 5 years as per your own estimation, a rough range?
See, before our US FDA issue started, maybe in the year 2012-13, when exchange rupee dollar was about 60, we did about 250 crore formulation business with about 10 products. So out of those 10 products, we have just manufactured and shipped 4 products. Few other products are on the verge of getting manufactured. So gradually we will build our business through Unichem on those initial products which were earlier selling in the market, in the US market. And we have very good cost benefit because of backward integration, our own API and all. In most of those APIs, I am also maybe one of the largest manufacturers in the world.
Understood. So whenever you cross, let's say, 100 crores or 200 crores of size, what kind of percentage margins are then recorded at Unichem level for the marketing?
Unichem, whatever, see, earlier also we were doing business through marketing partner. Those marketing partners are now replaced with the Unichem. There is a formula for sharing profit, for sharing cost of distribution. Everything is on paper. It will be beneficial to both Unichem as well as IPCA.
Yeah, I'm just trying to understand what is the dilutive effect it has, because Unichem is at
we have not spent any money for doing business. Whatever plants earlier we were manufacturing US products, they were as good as not manufacturing anything. Then we started gradually using them for other markets like Europe and all. In spite of that, their capacity utilization was very less. Once we do progression in our US business through Unichem, whatever overhead recovery will also improve. That will also indirectly benefit me, as well as my API additional production. So all those benefits will come over a period of time as and we go on improving our US business.
Understood. And when it comes to Unichem's own facilities, I think they are at 50 to 60% utilization. Is my understanding correct?
That is also gradually improving. Goa 2, which was newly commissioned, there also they have started gradually ramping up the production. So all-round improvement is there in the Unichem productivity also. That is also one of the reasons why operating cost is coming down because of higher production. So all verticals, wherever operational efficiency can be encashed, everything is being worked on.
Understood. And in how many years do you see that, you would be almost fully utilizing the Unichem facilities?
So next 4 to 5 years, I don't think they will need any further capacity other than routine capacity improvement plans and all. And whatever API they want to produce going forward, that capex is already happening at Pithampur API site. Formulation, they have adequate capacity available. So API, there were a little bit bottlenecks which are being now addressed.
Great. Thank you for answering my questions and all the best.
Thank you.
Thank you. The next question is from the line of Tushar from Motilal Oswal Financial Services. Please go ahead.
Yeah, thanks for the opportunity again. Sir, just again on Unichem, given that they are also now primarily into US business and IPCA also has. So any thoughts on sort of merging Unichem along with IPCA?
No, there is no currently any such plans. But the product portfolio of Unichem and IPCA, except few products which are common, rest are all different products. And as Mr. Jain has said, we are already having a plan to take their products to other markets. They were hitherto not present. Australia, New Zealand, most of the Europe, and also ROW markets. That action plan is already on. Product registration, document generation, all work is happening.
Got it. I mean, of course, the business-wise integration is very much happening, but then why to have two separate listed entities?
No, we have not thought on that so far. Just we are trying to now consolidate and improve Unichem performance. That is our focus.
Right. And so just secondly on domestic formulation, if you could share price, volume, new launches data for the quarter and for 9 months.
One particular reason for not taking up consolidation is also because we are looking for a strategy of hedging. If anything happens to IPCA or anything happens to Unichem, like we have burned our fingers in past. So we don't want that situation to have. And therefore, we are keeping quality and manufacturing everything separate. And so in the event of anything happening, you can produce product utilizing others' capacities and all. So business disturbance doesn't happen. And therefore, currently there is no such idea of merging both of them. Because
sure.
At the top of the mind of management is always there that it should operate as a hedging for each other.
Sure. So if you could address the domestic formulation question, price, volume, new launches.
Pardon, Tushar, what was your question?
So price, volume and new launches for the quarter.
Most of the growth was because of volume. New launches are hardly anything. Price may be overall 5 to 6%, not more than that. And as you recollect, last year there was hardly any price increase in NLM products.
Understood. That's it, ma'am. Thank you.
Thank you. The next question is from the line of Shiva from Purnartha Investment Advisors. Please go ahead.
Yeah, hello. And with respect to margins at standalone level, just wanted to understand, going ahead, are there any other, as you said, raw materials we did not get much of a benefit, you're saying it's only by the mix. So how do you look at going ahead? Is there any other operational levers at standalone level that we can show any improvement, or you feel these kinds of more improvement it will be slower?
Other than material cost, there was some increase in manpower cost because of addition of people. So as you recollect, last 1.5 years, we have added lot of people in the domestic market. Now they are slowly becoming productive for the company. So going forward, there will be some benefit out of growth what they will bring. So overall, our guidance stays. Going forward also, maybe next 3-4 years, 100 to 150 basis point margin improvement should come.
So normally our material cost used to be around 20% of overall sales. Currently it is around 21.5% or near about. It's largely because of addition of people. And a lot of those additions which we have made in past are yet to become productive. They are because it takes time. Somewhere in normal therapies, it takes around 3 years time. Chronic is sometimes it takes little more. So some of the people few divisions has become productive in very second year. But on chronic side, whatever numbers we added, that yet to become productive. And as their productivity moves up, we will have overall good set of numbers. Currently, in current financial, we are seeing that per man productivity has gone up by almost around 20,000. On an average, on total around 6,700 people. So that's the overall productivity improvement in the field. And this productivity improvement will keep on happening because we have added significant number of people in last few years.
Okay. So to be understand correctly, if there is no much change in the raw materials, the most of the production or the margin benefit will flow through from the employee cost is what we say.
Employment cost also will happen. Then overall, since once US business pick up, then capacity utilizations will also help in overall better improvement.
Operating leverage.
Yeah,
okay.
Yeah.
Okay. And with, you're saying about the MR, so if you could just give some details about the present MR and what is the productivity at an overall level and the 4 divisions. Like 2 years ago, we made additional 4 divisions. How are their productivity?
Overall, I think we have around 6,700 people currently, and overall productivity per month is around 4,45,000.
4,35,000 for this quarter.
25.
45.
Oh, 445.
Oh, this is for this quarter?
Up to 9 months current year.
Okay, 9 months. Okay.
Yeah.
And how does that compare to the last year?
It was around 4,25,000 with 6,300 people.
Okay, 6,300. Okay.
Sir, currently 6,700 and 4,45,000 per month.
Okay. And what do you, once they settle on, what kind of number do they hit? I mean, the new divisions, how will that look like once they settle on in 1.5 year, 1 or 2 years?
Productivity each year, even if there are 300, 400 people addition, will continue to have around 25,000-30,000 average productivity improvements will be there on continuous basis.
Okay.
Yeah.
Okay.
This kind of current improvement, what we are seeing in current year, that improvement will continue even after addition of people.
Understood. And how was your initial experience? I mean, you said that you've sent it to US market last quarter. How was the initial feedback, and how are you finding it right now in this quarter?
See, Unichem team has already started bidding for the products in which we have cost competency. So slowly and steadily they are gaining orders. But it will take time because there are already other players in the market and the sellers are already tied up with other people. So it works on contracts, 3 months, 6 months. So as and when people come for bidding, that time we participate. So there will be some gestation period from the day the goods is received and your sales commences. And then there will be a gradual progress quarter after quarter.
Okay. And the growth guidance, you're sticking with the guidance that you've given?
Yeah. So it is in line with whatever we are expecting.
Okay. Thank you. Okay.
Thank you. The next question is from the line of Sayan Mukherjee from Nomura. Please go ahead.
Yeah, thanks for taking my question, sir. On the EBITDA margin front, I think on a standalone basis, you are already 23-24%. Would it be fair that to assume the domestic business margins are materially higher? If you can give some color, given the fact that the employee productivities are rising, raw material prices have come down. Qualitatively, if you can talk about the profitability or EBITDA margin for the domestic business, and what are your expectations on that going forward?
See, Mr. Jain has already explained the major reason for this number is because of product mix change. So if you see business-wise, there is hardly any change in whatever we have been telling from the beginning, gross margin-wise. So only business-wise, there are different margins, and when the margins better business improves, the overall EBITDA and gross margin improves. It is that way. And wherever there is better margin, those businesses we are growing year after year.
Yeah,
for example, domestic and branded formulation business, ROW markets, typically they have the highest margin in the company's overall top line.
If you look at, let's say, current year anti-malarials has not grown. We have lowest margin in anti-malarials. Antibacterials is also low margin business. That has not grown. It's just 1% growth. Cough and cold is also generally a low margin business because it's all bottle packings and that cost of packaging is high on the product. So that business has just grown by 4%. All other business has grown faster and better where margins are better. So that is also reflecting in the overall EBITDA margin.
Yeah, so basically what I was trying to get at is the fact that if I look at 23-24% margin, your business has API, institutional on the lower side, and ROW India business are probably higher than the company average. So I'm just wondering if it is significantly higher or marginally higher than where standalone margins are, particularly for the domestic business.
Domestic margin will further improve. As the productivity improve, margins will keep on improving, and margins are definitely higher.
Okay. And sir, the other question I wanted to ask is, now since the businesses have stabilized or, on a growth path, what are the new areas the management is thinking about investing, whether it is India, US, if you can share any plans that you want to, that you can share at this point on new initiatives that, you are taking?
The new areas are, number one is, let's say, we are leaders in pain management. As far as your orthopedics and dentals are concerned, we have significant leadership there on those kind of products. And now we are trying to leverage those relationships and now started a new division called FlexiCare for adding the products for which are used by orthopedics for other indications. Because pain is one area, but they prescribe a lot of other products. So gradually we are ramping up. But right now division we have just added around 150 people. Recruitment of people is going on. So maybe another 200 people will be added. And I think next year that division will be, and we expect that turnaround and faster it should reach to the break-even point because we have strong relationship in these therapy area. So we should be able to. So we are leveraging those relationships. So that's one area we are looking at. Another area we are looking at is cardiovasculars. Now we have started beating the market growth and significantly compared to the market and now. And this is the further time for us to further consolidate our offering in the market. So next financial year we will again adding one more division with around 300 people in cardiology. Then another area is dermatology that we have done well and built business on dermatology in last few years. And we are missing on cosmeto-dermatology, so we have lined up the products and a lot of products under development and all. And I think one more division we will add in next financial year, somewhere in the mid of the next financial year, on cosmeto-dermatology. So wherever areas like say urology, we are doing well. It's giving us almost around 20% kind of, 22% kind of growth. So some people additions will happen in urology areas. So all these therapy areas where we are continuously consolidating, which are the high growth areas for us. So we are further investing on those areas. So that's a continuous journey.
And anything on the US, sir, in terms of ANDA filing across Unichem and IPCA, any product category segment? And how should we think about the research and development expenditure? What is it now and how much can increase?
Let's say our business philosophy is that we by and large use our captive product for the ANDA developments and all. So now last I think 10-12 years IPCA has not filed anything. But right now there are a good number of product pipelines which are there under development and all. So I think every year we should be able to now file 5-6 kind of IPCA ANDAs. And Unichem will also continue to do that kind of number. So, and more or less it's going to remain from, let's say, captive API. Some of the products we may outsource also, but broadly, so it's not that we have to file n number of products because our strategy is to always keep backward integrated products for forward integrations and all. So more or less we are not changing that strategy. So it will remain in that line here.
And R&D spend, sir?
Currently, both IPCA and Unichem put together, it's around 3.25% kind of R&D cost. That cost is likely to move to around 4%.
Okay. Thank you.
Thank you. The next question is from the line of Harsh Bhatia from Bandhan Mutual Fund. Please go ahead.
Yeah, thank you. Am I audible?
Yes, Harsh.
Yeah, thank you. So you, in the second quarter, you had mentioned that there was some US sales at the IPCA level that was shipped out but not booked. Have you booked those sales this quarter?
Sorry. You are not audible now, Harsh. What was your question?
Is it better?
No.
Yeah, hi, is it better?
Yeah, tell me.
Yeah. So we were saying that there were some U.S. sales in second quarter that were not booked. They were shipped out but not booked in second quarter.
No,
Those
you
sales
are
have
not
been booked in
audible.
the third quarter?
You are not audible.
Sir, I just request you to rejoin, please. The next question is from the line of Bharat from Equirus. Please go ahead.
Hi. Thanks for the opportunity. So we have done phenomenally well in the past years in domestic business. So how do you see this business behaving as compared to the IPM in the at least next 2-3 years? If you would talk a bit about it.
So more or less, whatever our growth, 1.5x IPM growth, hopefully we should continue with that coming few years.
How big our pain management therapy would be in the overall concept?
About 52%.
52%. So somewhere the largest product would be $0, and if I'm not wrong, that product is almost like 750-800 crores.
In spite of that, the pain therapy has grown by 14% in the 9 months of the current financial year.
And are we calling out how big is $0 for us at this moment?
So 2 $0 SKUs are amongst the top 300 selling 3 SKUs, top 300 selling brands in the country.
Right. So are you expecting pain management to stay at almost like 13-14% growth going forward as well?
Yeah, definitely. Unless pain management grows 13-14%, I can't grow 1.5x the market growth.
Right.
Because that is almost 52% of my overall business.
But what is driving this growth in the oral pain management? If you could talk about and how this growth will be maintained, because we will be covering large part of the market. Earlier, the doctor access will be also one of the foremost when it comes to the pain management. So how we are looking to maintain this growth going forward as well?
Let's say your not only osteoarthritis products, but rheumatoid arthritis products are also growing faster. And it's the more penetrations of disease prevalence in the country is very high. It's all we have to create enabling of the more number of rheumatologists practicing in the market and taking those rheumatologists to the other areas and educating doctors and all. So rheumatology portfolio is the last 10-15 years also we have seen continuously it's growing 1.5 times the market growth, and we don't foresee in next 5 years also that growth rate can come down. It is significant work is still to be done to make all these therapy available in any nook and corner of the country. And as far as the pain is concerned, the Zerodol is continuously growing. Even in these markets also it is growing faster than the overall IPM. It's almost around 1.5 times the market is growing, and we don't see any kind of problem in growing this therapy also in next 3-4 years at current pace. So we are not seeing any kind of challenge. And as far as the new product offerings are concerned, there are not much on particularly on osteoarthritis side. On rheumatoid arthritis side, yes, there are a lot of opportunities and of the new patented products, and we are working on everything of that. So we are keeping our complete hold on that kind of things, and we will continue to add the new product portfolios as and when the patent expiry happens and all. So we are further augmenting our ortho offering by addition of new divisions which we are currently in process of doing that. So that we can leverage those relations in the particularly in ortho segment. So that segment will continue to remain focused for us, and we don't foresee any kind of difficulty in growing this business. In fact, it will grow faster than the overall company growth.
And every major product I am selling in pain category, I am the market leader, and my growth is higher than the market growth.
Okay, sure. Thanks a lot, sir.
Thank you. A reminder to all participants, you may press star and 1 to ask question. As there are no further questions from the participants, I now hand the conference over to the management for closing comments. Over to you, sir.
No, more or less, most of the areas we have covered in the Concall. I don't think there is anything further to be added. Thank you. Thank you, all the participants. Thank you very much.
Thank you, sir. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.
Thank you.